Hey traders, what's going on? It's Chris at Verillo Trading. Welcome to today's video. In this video, I wanted to talk to you guys about a few things regarding trading and trading the stock market, day trading. So if you're interested in trading, this is a good video for you to watch because we're going to talk about certain things that are important for traders to do. One of them is the act of debriefing your trading sessions and how important this is. I want to explain to you why this is so important. A couple of reasons why, okay? So debriefing your sessions, and one of the most important things, which is, in my opinion, emotional regulation. Okay, the next thing after that, I did want to talk a little bit about how traders tend to get into these fixed mindsets about different styles of trading. And they say, for example, oh, I'm a scalper, I'm a swing trader, I'm this, I'm that. And I want to tell you guys, I want to explain to you my perspective about why the markets don't care about those things, and that a trader can't be such a fixed, you can't have such a fixed mindset as a trader. The point of being a trader is in a way being adaptive, and you want to basically go with whatever the market is offering, and you have to adjust your strategies to do that. So I'll explain to you a couple of ways I do that, and what I've been working on lately. And by no means is this perfect information. As you guys know, trading is very complex, and everybody's sort of in their own unique situation regarding trading. Everyone has their own level of life experience that can impact your ability to make good or bad decisions. So most of what I'm saying to you guys is from my own perspective, so there's no guarantee that I can help you, but hopefully I can share with you some information that you can potentially relate to that can help you make potentially some better trade decisions going forward and be aware of things, more aware of things. Thank you for watching, and if you enjoy this content, press the like button and click on the first link in the description. Awesome. So let's go over to the charts here and we'll talk about a few things. So the first thing I want to talk about is session debriefing. So there are many things that can happen when you're trading, right? So you can be on a good winning streak. For example, the last couple of days here, yesterday I had two trades. Both of them were winners. One of them was a 100-tick winner on crude oil. The other one was a 5-tick winner on the 5-year treasury. Today as well, I waited for a setup all day long. I didn't trade in the morning. Markets were slow. And then I hit my setup here close to noon, and I'm blocking the chart, but basically it resulted in a nice trade as well. We were playing on the long side here on the 5-year treasury. That was my only trade of the day, and I waited for it all day. So I want to explain to you my perspective. So let's say you could be having a very good day, a very bad day, a medium day, totally break even. Maybe you're break even 3 days in a row, all right, and you're frustrated. All those things require the same thing, which in my opinion is called emotional regulation, or some sort of emotional debriefing process that you have to go through to help you sort of regulate your thoughts and your emotions into a balanced state so that when you go into the next trading session, you are prepared to make good decisions again, like you normally would be, and you're not going to be influenced by any emotions that are there lingering in the background. Any lingering thoughts, negative thoughts, or emotions like euphoria, frustration, and anger that is built up in the background that is not dealt with. Now, I'm not sure if I'm going to be able to give you guys good strategies to deal with these things, but I'm just sort of explaining to you that this is something that you should be putting more attention on in your own trading. And it's something that I find that new traders, myself included, over the last few years have failed to do. And that's kind of what results in you taking trades. You have a couple of good days and then you end up giving everything back, and then you look back on it and you don't really know why you gave it back. You don't really know what led you to take those trades that you traded in a slow, choppy market, or maybe you just were over trading in a certain particular area and you weren't aware of your potential biases that you were developing, or any potential unresolved thoughts or emotions that you had that were potentially influencing your decisions in those moments. Okay, so this is something very important. So debriefing your sessions is one thing. So when you take your trades, of course, doing the work to review your session, review your plan behind your trades, review what you were seeing, what you were thinking, how you were feeling, how much sleep did you get, how things were playing out, how was the market trading, and were you keeping track of your reads in real time? One thing I like to do when I'm trading is I kind of come up with a few different ideas and scenarios for how the market is likely to play out for the day, and sort of play them out, in your head. And think about, okay, well, if the market does that, then I think we might have a bit of inventory on that side. So I don't want to be looking for shorts if this happens. But then if that happens and then that happens, then that's sort of a different scenario. You see what I mean? So you're kind of playing out different scenarios for how the market is likely to play out. And what I'm explaining to you here is not something that's easy to do for a new trader, because it requires a lot of experience and understanding of how you operate in your trading strategy and in your market, right? So market context. So one thing I think is really important for traders is that when you finish trading, you have to be aware that you are influenced by the decisions and the outcomes of the decisions that you made. You're going to be feeling emotions, okay? You're going to be feeling some sort of emotions. So you need to take responsibility for that. You need to take an understanding and awareness of these emotions that you are feeling. And the other big takeaway from this is that a new trader versus an experienced trader, they're going to have different strategies for how they deal with them, because of course the more experience you have doing a certain thing, certain things are not going to impact you as much as they will other people. And again, everybody's different. And that's why this is such a hard topic to talk about, because nobody will be dealing with their emotions the same exact way. And that's why it's tricky. But there are some commonalities, right? So for example, if you have 3 break-even days in a row, if you haven't sat there and reviewed your sessions and done the work to regulate that slow buildup of frustration, if you haven't done that work, then you're not going to be at an advantage the next time you approach the market. In fact, you're going to be at a disadvantage because you're working with unresolved emotions in the background, influencing your decisions. You don't want to be in that state when you're trading. Now, I want to tell you guys that in some scenarios, it might be even better off. You might be better off skipping a trading session if you haven't resolved your emotions, you haven't reviewed your sessions, you've been slacking on your trading work and all that. You're not going to execute well. So everybody has built up emotions over time, and sometimes these things are even unrelated to trading. So I'll give you an example right now. I have new neighbors. They're living upstairs from me, and they're pretty loud. They make noise, they stamp their feet, they got kids, and it's all in my head, but it's distracting, and it builds up some sort of frustration inside of me because it's something that I'm not used to, okay? And because I'm not used to it, I have these thoughts about it, and the thoughts, they cause emotions, and that builds up in the background. And if I don't talk about it to anybody, if I don't deal with it, if I don't hear it in some sort of a response of a conversation, they're going to remain inside, and then I'm going to continue to have that built up frustration inside of me about my neighbors making a fuck ton of noise. So that's one aspect that's even unrelated to trading that could influence my trading decisions, because I have built up frustration from that. Another way to deal with this, another way to do some debriefing of your session, is you have to talk through your trades from start to finish. And ideally, you want to do it with a trader that is also experienced, that understands your trading, that understands the markets, and talk about your trades. Talk about them out loud, how you plan them. Break them down. I think it's very good to break down trades. Here's what I want you guys to remember. It takes time and energy to resolve built up emotions. Don't expect yourself to just resolve things in a couple hours or even immediately, right? Some of you guys have very unrealistic expectations about what you're able to accomplish trading the markets. And sometimes you use benchmarks of other traders that you see who have been doing this for much longer than you, and who are also older than you, because I know a lot of you guys on YouTube looking about trading, you're pretty young guys in your 20s and 30s, 20s mostly. And I'll be honest with you guys are at a disadvantage to other traders who have more life experience than you, because I believe people who have more life experience, street smarts, have an edge when it comes to decision making. Therefore, they have an edge in trading as well. Not always, but I'm just kind of generalizing a little bit. I believe older men, like in their 30s, have an edge slightly over younger men in their 20s. I don't have to explain to you guys why, but I think you guys can understand why as well. And you shouldn't feel bad for potentially even missing trading sessions or not looking at the market altogether for a whole day if you need to, a couple days if you need to, because you're spending time doing the work to resolve those emotions, to make sure that when you approach the market the next time, you're ready to execute your fullest potential. You're ready to give it your all. Sit there and wait for your setups and not be influenced by fear, greed, euphoria, and any kind of built up emotions that you have from past trades that you took the prior day, prior 2 days, or any other emotions that resulted from emotional conflicts you were involved in. Okay, so this stuff is all very important, guys. You might not believe me. Some of you are going to think, trading psychology is a bunch of bullshit. But there's some aspects of it that you can say, okay, these guys are just talking about a bunch of voodoo. It's unrelated. If you know how to trade, you know how to trade. But what I'm trying to explain to you guys is that the reason why people go to the markets and they end up giving things back is, I'll give you 2 reasons why. One of them is because they have built up emotions that they haven't dealt with, and that influences their decision making in a negative way. Because in the background of their actions, there's that built up of fear, frustration, euphoria that is, influencing them. The second reason why traders tend to give back what they make is because the markets, by design, are designed to clean you out. And most people are simply not really even aware of this. They think about it some different way. But I believe that the market's purpose is literally to clean up everybody's accounts, or as many people's accounts as possible. And the reason for that is because it's always seeking for new business to be done. So in theory, if you just get into a trade and then never cut it, let's say you get into a trade and you have a stop loss and no target, most of the time it's going to end up at your stop loss because it has a way of rotating. And I'm talking mostly about futures markets, these modern day markets, modern day price action. They're designed to take out liquidity every single which way. So before the market moves, it's going to make a test to the opposite side. It's going to do the break-even test, may even need to do it multiple times. And if you're not prepared for that, if you don't understand that that's the way markets move, you're going to get cleaned up. And also, if you don't understand the way the market environments shift kind of day to day based on news reactions, market sentiment, the context sometimes is just not favorable. All these things, if you don't know them, you're going to get cleaned out because you're going to be over trading on slow days. You're going to be under trading on the good days. So you're not going to be making as much on the days where you need to actually be sitting there, waiting for the setups because those are the days you need to be there for. And then on the slow days, you're sitting there trading anyways when you're over trading. So you're going to be getting cleaned up slowly. And overall, you're going to be negative expectancy because, fees, commissions, and everything's going to add up over a long period of time. And you're not going to make money doing that, right? Trading is very hard, guys. There's lots of components that go into your overall profitability. One of them is the process of self-regulating after every trading session, during the trading session. And the other one is, of course, having a big understanding about what it is you're doing, why it is you're doing that, your setups, why you're trading that particular setup, and basically having experience and understanding about the marketplace. Okay, let's move on. I want to talk to you guys a bit about trading identity very quickly, and then we'll end the video. So traders, I notice, especially beginner traders, you go through these courses, right? And you learn about specific ways to trade. Let's say, for example, scalping. So you take a course and they teach you about scalping, how scalping works. You have to take quick entries, quick exits. If the trade's not working, you get out. But I want to tell you guys about something. You can't just be a scalper and make money in today's markets. You just can't, because there's some days, there's some price action that is meant for scalping. And there's some price action that if you try and scalp in that, you're just going to keep getting run over. You're going to keep getting cleaned up over and over again. And the market by design is like that. That's what it's meant to do. It's meant to clean up everybody whenever the time is right for them to get cleaned up. At some point, if you're stubborn, if you stop adapting, you're going to get cleaned up by the market. Okay, that's what I believe fully. Don't be afraid to try and adapt and try and learn new ways to look at the market, but within your existing parameters of how you already see the market. So my own perspective is, for example, look at a market like crude oil and then look at US Treasuries. The liquidity is drastically different in those two markets. The way those two markets trade is drastically different. There's different correlations. There's different things influencing the order flow and price movements in those markets. Therefore, they trade differently. So you need to adapt to that, basically. So you can trade treasuries from more of a scalping approach. There's some days where you can, and there's some days where you can't. There's some days where they're too efficient to be scalped, and you're going to be sitting there getting run over. If you're running like a short term, like a 2-3 tick stop, you're going to get run over. It's going to clean you out before moving. Now, if you're a smarter trader, you would wait for the traders that are doing that to get cleaned up before getting into the trade, right? So it's all about, taking the next step forward beyond the traders that are not adapting to what's going on, okay? That's kind of what trading's about. And talk about crude oil very briefly. Crude oil, short-term action, I don't believe it's very good for scalping. I mean, especially if you're only looking at like one market, like if you're looking at crude oil futures like this on an order book, I mean, it's so thin, and you guys know very well that most of the order flow is not taking place in the futures. There's order flow separated between the spot market, the USO ETFs, the options market, and various futures contracts and all kinds of stuff, right? So you can't track the order flow just from one contract. So if you're trying to look at the bid and offer here and scalp based off of that, you're probably gonna have a very hard time. Okay, so personally, when I trade crude oil, I look at it from a bigger picture. I look at the daily, 15-minute, and I look at that contextually, and I take bigger picture plays, like 100 tick stops mostly. Like yesterday, for example, I had a bigger picture play on crude, and I was running a 100 tick stop on that particular trade. And as soon as I got in the trade, I was offside by 50 of them. But because I had a bigger picture idea, I wasn't freaked out about that. And the way it happened as well, contextually, It happened so fast. It was just a big cleanup, 50 ticks offside, and then it took about 5 to 8 minutes, and it slowly started recovering. And then the original trade that I had going on, the plan for the trade played out in pretty much the way that I had that I was planning for. And of course, I was planning out different scenarios for that particular trade. We can kind of look at that trade if you guys want. But so, for example, crude oil is the type of market where I will look at bigger picture plays. And if you look at this, right, a scalper will look at this and say, wow, that was a terrible entry. In fact, that was horrible. But that's because you're so stuck in a scalping mindset that you're forgetting to realize that the markets operate more than just on a scalping time frame. There's so much going on. There's so many players. You have your 15-minute zones, you have your daily chart players, and everybody's looking at the market at the same time when it's trading. So you have to understand these different perspectives. And for me personally, crude oil works best, bigger picture ideas. I stay away from scalping crude oil. So again, you look at that entry, you're like, whoa, bad entry. But I honestly didn't know that it was going to do this as soon as I got in. I was getting in at a price that I thought was a good price based on my market context. And it turned out, bigger picture, that that was actually a very good price, because if you look at what it did after, I mean, it recovered soon after, it didn't look back. Realistically, anything over here, institutions believe this to be kind of on sale. So I guess you could say, well, I got a decent price, not the best price, but I got a decent price. And another thing is, in trading, you can't get the best price. You're not Goldman Sachs. This market recovered, tested the break even, and I got paid because we moved very quickly to the target zone on this particular trade. And for the way it played out, I had to get paid on that one particular. So I made about 100 ticks on it. The overall risk on the trade was 100 ticks, but based on how fast it moved to the target, I believe that the risk reward changed in that instant. And that if it was going to move up there really quickly, it was a high odds that we were going to reverse back and then chop for the rest of the day. Whereas if it was going to do more of this type of action, this was like the point of control the prior day, by the way. And if it was going to do this type of action, we pulled back, came up here, then pulled back, went for another test down, then went sideways, and then started to grind its way back up, that was going to be the original trade that I had pretty much planned for. But based on what we got here, the trade for me was a cut early, and that was it. So you could say it was a 1-for-1, right? Risk 100, made 100, but based on how the trade shifted, I don't think it was a 1-for-1. I think it was a lot better than a 1-for-1 personally. And that's something that traders also have trouble with. It's that you're always going with like a fixed risk to reward in your mind. You're saying, oh, I'm going to risk 1 and I'm going to make 2. But you don't realize that as the market is moving, that's always changing based on market probabilities of how the context is evolving. And I think most new traders don't even know this. They think, okay, as long as I trade with a good risk to reward, I'll be good. But if you understand the nature of markets and how they're designed to clean everybody up at some point, you'll know that as a trade is playing out, the expected value, the risk to reward, and the context behind that trade is no longer the same as it was when you originally got into it. There are some cases where it can remain the same, but there are cases where the context can shift entirely. Like in this case, where I said, basically, if this market goes up to these 60s and 70s, if it starts shooting up towards the high 89s and trades 90s like that, that's a cut, because this is a poor high resistance and we're shooting right into it with high velocity, and I'm long down at these 88 and something, 88, 90, right? So I mean, that was a cut. That was a for sure cut for me in that instant. Either that or I was going to be willing to sit through that all day long, and personally I wasn't. So it's about the decisions that you decide to make, with the information that the market is giving you now. And hopefully you can continue to make good decisions. Get yourself a trading buddy. Talk through your trades from start to finish. Explain to them why you took them. Explain to them the context behind them. Explain to them what you would have done if it didn't play out, how you were going to do it. So I'll run you guys through this particular trade now. This trade on the US Treasuries, okay? All day long, I was waiting for pretty much some long side momentum. And the reason for that is because of the context of where we opened overnight, how it traded overnight. It was an inside day, and we had a lot of these tails, a lot of these sort of stop runs to the short side, and it was kind of influencing shorts to participate in the market. And at the same time, the context is lending itself and telling me that if this market starts with a bit of a rally, I think there's going to be a bit of an imbalance of order flow that can potentially contribute to a continued rally, which is why, in my opinion, I don't want to be looking for shorts if we start continuing a rally up there, okay? And that was one of the reasons why I wasn't looking for shorts today at all on US Treasuries or even on ES. And one thing I found interesting about ES is that there was a bit of positive correlation between Treasuries and ES at some point, and not totally, but give or take, like there was a bit of positive correlation there. When this move took place, ES was above its demand zone. It had tested and reclaimed it. So basically it was long biased. The S&Ps were long biased at this moment as well. At the same time, I believe that there was an imbalance of liquidity that was needing to be squeezed out. So the way this particular trade was executed was I waited for it, and I had a good read on the volatility. And I also was lucky on this one. I almost got executed on this bar right here at 1151 because I had a buy stop there that signaled to the market that I wanted to be buying the ask when the ask drops below about 100 contracts. And what happened was there was a buyer that lifted the offer, but in the moment they did that, there was more offered. And for whatever reason, my buy stop didn't get triggered. And because it's a client side condition, I guess the offer came back so fast, like in a microsecond, that my client side didn't even have time to react to the offer getting taken and then getting reset. So I wasn't triggered. And what happened after that buyer came in and lifted about 400 contracts at 75s in this instant is they pulled the bids, they cleaned them out all the way back to evens. And this is kind of some good price action. So basically I put my buy stop, I left my buy stop there because after a cleanup down to evens, which was basically where the most trades were getting sucked in and trapped. I guess shorts were kind of getting trapped around these 25s to evens in this range. After they cleaned up evens again, if we trade 75s on the other side again, I think there was a good chance for a breakout. So I did get executed on that the next time it went up there, and I bought 75s, and it didn't look back. In this case, well, hindsight, of course, it looks like a beautiful trade, but there's some cases where, you know, it would fail as well. But I think that based on what I was looking for in this case, I wasn't looking for it to go clean up evens again because it had done that already multiple times. I mean, it cleaned them up here, and then, I mean, you traded 75s, cleaned up evens again, and then you're going for a momentum on the other side. That was pretty high probability for me, and at the same time, I believe that the market had room to go. So that was a momentum execution right there. And 75s, people are gonna ask, why did you trade 75s? Because it was lining up with the volatility, and that's all I'm gonna tell you, basically. I'm not gonna explain to you exactly why it was 75s because there is a particular reason why I select certain prices for trading. You know, you gotta learn how to see the market from multiple perspectives, in my opinion. Don't get trapped in one mindset, guys, because the market's gonna clean you out. All right. Hopefully you guys spend your time debriefing before the CPI number tomorrow, Thursday. I'm going to definitely take some time to rest, and that's it. So thank you for watching, and I'll see you in the next video. Take care.